Well, after that rate hike came through, we also, of course, heard commentary from Jerome Powell. This is, of course, the ninth hike that the Fed has delivered since March 2022. The Fed expressed caution about recent banking crisis, and it also indicated that hikes are perhaps nearing an end. Let's listen in to what Jerome Powell had to say.
Inflation remains well above our longer-run goal of 2%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. We published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Everything was fine up until then because the market took this as a dovish hike. It was along expected lines, but then came the quote from the U.S. Treasury Secretary Janet Yellen. And I just want to put that quote up. It was that single one line that completely derailed the bull's case because the Treasury Secretary came and said, I have not considered or discussed anything having to do with blanket insurance or guarantees for bank deposits. And that was contrary to at least what a section of the market was building up in the form of a hope trade. And therefore, there was an unwinding of that hope trade that literally played out. Let's just discuss this further with our first guest on the show, Abhilash Narayan, Senior Investment Strategist of Group Wealth Management at Standard Chartered Bank, is now joining in. Thanks very much for being with us this morning. And my first question really is that the market in a what next and what now mode, given that a lot of these big announcements and events are out of the way. So, Abhilash, how would you look at India and playing the market here now?
Right. Thanks for the question. And obviously, a lot has happened in the past week or so. But, we have two more central bank meetings later today. So we've got the Bank of England as well as Swiss National Bank, who will be announcing their rates later on today. And I think the most closely watched one would be Swiss National Bank. Obviously, we've seen the saga between Credit Suisse and UBS play out. So it would be very instructive to see whether they are still focused on fighting inflation and raising rates, or does the banking sector stress lead them to sort of put a pause or slow down on the path of rate hikes. But I think as far as equity markets are concerned, be it India or global, we think that the markets are likely to remain choppy. Volatility is likely to remain high, at least for the next few weeks, till we get a bit more sort of easing off of the concerns at the moment.
So would you stay away from equities altogether, be on the sidelines because of this lurking risk now in global equities? Because even if something happens in the US, there are repercussions, there are linkages, which drags the Indian or the Asian markets lower. So what's the call on emerging markets now? And then if you could, talk about US and then India.
Absolutely. So as far as Asia ex-Japan equities are concerned, we are overweight on the region. And in fact, we are neutral on US equities. So we do prefer emerging markets, especially Asia, over US and European equities. And the reason for that is simple. While, India, China, Indonesia, Malaysia are expected to post, healthy GDP growth, in US and Europe, we assign around 70% probability of recession over the next 12 months. So the stronger economic backdrop should be positive for Asian equities. Now, within Asia, we are neutral on Indian equities and have an overweight on China. And the key reason why we are neutral on Indian equities is because we think that on a relative basis, they are trading expensive. So I think they're trading around 55 to 60% higher on a PE ratio compared to MSCI Asia Japan. So that valuation premium is likely to be sort of something that caps further upside in Indian equities or relative outperformance of Indian equities.
All right. Abhilash, we were going through the comments that came through from Powell as well as Janet Yellen, and it is a little bit in contrast, right, what came through. So what is your reading of that? And are you also someone who believes that this entire banking story is likely to subside in the next couple of weeks, and then the Fed will perhaps go back to, the complete focus on the inflation fight? How do you think that's going to play out? And how are you reading these slightly contrasting comments that came through?
Well, if we start with the Fed, Fed is in a tough spot right now, and the comments from Fed Chair Powell do sort of indicate their constant focus on inflation. Because if you look at the underlying drivers of U.S. inflation, some of the core inflation drivers such as shelter or housing and service sector inflation are actually accelerating, despite the 450 basis point hikes we have seen in the cycle before the latest hike. So inflation is a concern, and if you look at Fed's own projections, they do not expect inflation to come down towards 2% by end of 2025. So that's almost 3 years out from now. So Fed is focused on inflation. And I think the risk here is that the Fed over tightens and we end up seeing US economy slow down. In fact, there are some people in the market who believe that Fed is concerned about the strong labor markets and would like to see unemployment just edge up a little bit so that wage pressures do subside in US. Now, as far as Janet Yellen is concerned, obviously, there was some hope that banking sector in US would get a blanket sort of insurance which will help ease the concerns around regional banks. But we saw the statement what it was, and that's one of the key reasons why we saw the banking sector decline quite sharply. Now, as far as the regional banks are concerned, we think that this while the near-term stress may subside, there is going to be more regulatory focus on the regional banks, and that could keep the sentiment around the US banking sector a bit more subdued, and that's why we think that healthcare sector is one which is likely to outperform the financial sector in US over the next 12 months.
Abhilash, got that. That's a very fair and valid point. But I just want to come to your view on India. You said that you're neutral on India. You're still overweight on China, and that's interesting because we were speaking to some of the strategists at some of your peer banks. Got a view from JP Morgan, also from HSBC, if I remember correctly. And the view there was that perhaps this sell India, move to China trade, which started at the beginning of 2023, that's petering out. It's on its way out. You don't think so? Why the neutral stance on India despite the valuation correction that the market here has seen?
Right. I think that's a valid question. And if you look at it, over the past 1 month, Indian equities have outperformed the Chinese and the broader Asian markets. So we have seen a bit of a catch up to the underperformance of Indian equities that we've been seeing for the past few months. Now, if I look at the next 3 to 6 months, obviously there are some very positive factors for India. GDP growth is expected to be around 6% in FY24. Earnings, we expect them to grow by around 15%. But it's just the fact that valuations are expensive, not only relative to Asia, Japan, but also versus the long-term average. If you look at Nifty, so long-term PE ratio is around 17 times based on our estimates. So we think that elevated valuations, especially when you're thinking about potential recession in US and Europe, are just going to be something that caps the performance. If you think about China, obviously we've seen a bit of profit taking after the 50% rally that we saw since October, but we still think that the market may be underestimating the earnings growth there, and that's why on a relative basis we think China may outperform India. But if you think about it from a global perspective, we do expect Indian equities to outperform both US as well as European equities.
You said India is trading at a valuation premium of 55 to 60% to the region. What, according to you, is the fair valuation premium India should command? How much lower does that?
That's a tough question. Yeah. Well, I think depends on the environment and the flow picture, right? So historically, India has always traded at a premium relative to Asia ex Japan. So what's the fair premium depends on the economic regime. But we think that, given the fact that the current account deficit is still sort of elevated, it's come down. It's been held by lower oil prices, but it's still something that we are watching. And there's obviously the risk that, if we do see a recession in US and Europe, you could see some outflows from emerging market equities and bond funds. So that's what's sort of keeping us from being a bit more optimistic on India just as yet.
Okay, so you are saying that even though valuations have corrected, perhaps not enough to find comfort. Are there pockets within the market where you think that has happened, which now appear at these levels more attractive?
In general, if you think about Indian equities from a market segmentation perspective, we like large caps over mid caps and small caps because we think that large cap names are more defensive and they have more buffer as far as balance sheet strength is concerned if we do end up seeing a global economic slowdown. But if we move to sectors, we prefer the more domestically oriented sectors. So sectors like banking, which is obviously benefiting from improvement in asset quality, but also sectors which benefit from India's infrastructure push. So industrials, construction-related companies. We would be a bit more cautious around the IT sector and pharma sector, which are more dependent on export-related earnings or earnings from abroad. So domestic over international sectors would be our pick within India. Sorry.
All right, Abhilash, we got that. Thank you very much for joining us and taking us through your call in the market, and as well as how you really see India positioned within the broader Asian landscape. But that is the word coming in from Abhilash Narayan, still saying that valuations have corrected a fair bit for India, but it's still perhaps quite expensive compared to what we're seeing in the rest of the region, commanding around a 55 to 60% kind of premium. But with that, we are going to get into a short break on the show. On the other side, we're going to shift focus from equities to talk about what's really going on in the world of commodities. Manisha will be with us.